and A class so that kesi nkoma so na seda kesi nkoma director David ono so abeka ho e wo fidi man say na me sa so aka mo biom say me sraw oba so a share ema wo busuafo share ma wonyanom. It's better for them to know near course dance oba koti akoka kire ti koka kire de yesi ebokuro nti ono nsa te a na afedi ono nsa afemu aba na adesua bi ewom bi adon nsa afa sabre yebekọ ne akokop da aboafo a aso yasen yakwa yo match ne adom ase so kakra because mpanyefo say okoto sa abo bi si papa so a na enya ne pe anana ho ade bi no da kosi o na emom no obi ne kokru de si o na o kan kwa ase on ma no yakanfo ho ma de ti miensa chiche mudu miensa no o kan kwa ase on ma o se na medua so ana ahoma eho no soro the same thing no na ye di aseda kese ema feel good services say ayomo Daruma na fi the edijubedi Abraham feel good services say about mental health and I say be any mental health education and I say illness and I say be health na open mecha kwan with feel good services at gmail.com or me no be din kita na fi de bibia akoso wano so na feel good homes or say open bia wodi beto na bibia aye kama na fi de okogana woni umbo tata Figu Homes Echira Kwan. Ebiom Roshala Homes eso say so pe location papa beda bra nebepe bia panefa wuti eto. Omunya so mo location wo Pokwase Adringano ana East Legon Hills. Internet so peso ko humbo ho adwa kakra na afede vacation bi na akwa. Mr. Ofra bo a mo hu say PK and the information ma on ejo discount kama. Ebiom yebasa so ada Oswald Wellness Clinic so ase ni asaso ada Happy Glow GH so what Ghana na say wokokoye wo nine pedicure manicure facial expressions na be purchase all your facial nemani nyina cosmetics ni beauty supplies ni nyina Happy Glow GH na be kan fa ma any obusuafo nyina so wa ma no ne so asera wo obusuafo so bonko omo Ashoman estate onom 20 meters away from the clinic no and right opposite from Veggies and Grow na afedi omo ne omo enkodi nkitown opemu na chese me saso akacho se sabre uni tap send anasa what tap send nasa we busu for any tap send na me sraw from kacho so mo App Store na say Apple Play Store Apple Play Store na say Android for the crap your friend say mon kai me Play Store and Apple first say Apple we do friend say App Store now we're gonna download the tap send. O download there, Michelle say make sure say o the information you be share more right for the first time. A dear what card and so make sure say ni na MH because so o right the first time na you must have questions baby na fi there and create any issues be my account yanko block and as yanko holding the app into Mr. What the information you share we are now fi there promo code now for your first transaction AHRE. Or the HRE shema will be $15 on your first transaction. To Bomodia na fede so one ye emame. So why so dia na misro to Emma Ubusia for almost so enyebi. Sabre the Bekwa Coffee Director David na fede or the Inkabosem bia wo atudwa amai. Ye we are na fede ye host your guest I ni di nkomo last week. Nana Kwame Akowa. Yes aso ne na twetwe nkomo. Kwanya ye fa so etofie ewa America ana taxes on some no so you better to also in there because taxes in man they were from now to March 15th there obi an say taxes in and taxes that kwa see April but yes of course payment to the best start hit in March. It's always good to get your taxes in as soon as possible into Mr. Ma from you know so Emran BTB sorry you couldn't go to Director David Director yamwa akwaba eba jubede so.
Good evening, PK. Good evening, Kwame. Obi Amabe, thank you so much. But you say a holiday. Happy Martin Luther King Day to everybody. That must pass when your time about it. Boss, Kwame, cool. I know last week I said so. Thanks again for making the time for us again. That was possible, but meaning say a holiday, baby, I now. But from Tap, it's not going to be much. We're celebrating a holiday in the States, but still, your boy man for me. So. Not much from us. Again, thank you so much for coming. Not to hold too much time. You said buying homes in America, first-time home buyers, FHA. There's so many ways to buy it. And I think now Kwame will lead us with more in-depth conversation around internet. I'm not going to hold too much of your time. So again, Thank you so much, Nana Kwame, and then PK, back to you.
Thank you. Now, director, why you always give me something for me to laugh about? Nipa no America, buza say baby you're on holiday or your holiday swala.
I didn't know. Maybe he's on vacation. I don't know.
Oh, okay. Good way to defend yourself. That's a very nice try.
Nana Kwame, PK, back to you.
Hi, Ebusiafo, Yefa Akwenya Isuda, you introduce your guest and your host. He's an accountant, business owner, and a businesses owner. And as the owner of so many different businesses, he also helps people to, own business as well. And and also another thing we'll discuss down the line in the future. If you want to learn how to easily own a business in America, own for a lot of tedious way down. He's also a family man and also a great person to educate us when it comes to this. Until Nana Kwame, Yama Kwaba Eba Jumedezo.
Thank you very much, PK, and thank you all for just bringing me back again. I appreciate everything. So I want to start. I do have, I don't know, Uncle they come and join to listen, even on YouTube, So I will go all English, not because Minty but because I really want the people that don't understand P to be able to understand what I'm sharing. I hope that is okay.
It's very much
And
okay.
yes, beginning, like I said last week, if you just stop me, I'll be able to slow down and then answer any questions and go through any information that is necessary. So actually, just based on information now we shared, today we are just going to go over two main things. Okay, and then I will take my time and then kind of discuss some things. My hope is every day when I have opportunity to talk like this, that one thing via, it will make sense to somebody, can help save the money. I'm all about money. If there's something that I can share that will save you $100, $200, then I feel okay. So hopefully today the information I'm delivering will be something that can really make an impact and then make a difference in somebody's life. So I'll talk today about taxes and home purchases. But before I start, I always want to make this disclaimer. This is really important. The information I give today is for informational purposes. In no way is it a legal advice or even accounting or even as a real estate advisor. This is just for information purposes. If you are going to buy a home, you want to do your taxes, I'll be happy to do a one-on-one session with you to help you with your taxes. But what I share here today is for information only. And then you can all do your own research or connect with your accountant or real estate person for more details, okay? So with that, I think most of you were introduced to me already. My name is Nana Kwame Akowa. I'm an accountant. I'm a principal accountant at Tri-City Business. It's a company that I'm a partner of, that I partnered to found. I'm also the owner of Global Line Consulting. PK says something interesting. I do love buying businesses. People love real estate. I love real estate, but more important, I also love buying businesses. And so one of my goals this year is to take my time and really do a 4-week session on how to purchase businesses and the strategies you can use to negotiate businesses and all of that. More information coming soon. Right now, it's a busy time for me, so I may not be able to do it in this season, but it's definitely something that will be coming out. So keep an eye out for that. It's going to be great. Okay. But just getting on to today's topic, taxes, right? One of the main reasons for you to really think about taxes and to plan for your taxes is to give you an opportunity to save money where you don't need to spend money. Taxes, at the heart of taxes is law, right? The U.S. Congress or the Senate, they have so many laws and loopholes that sometimes just the lack of knowledge can cost you so much. I'll give you a good example. I had a gentleman this year, and then I know when I brushed off last week, I didn't go into details, but a gentleman called me this year around the month of May, had received a letter from the IRS and owed the IRS over $7,000. He couldn't understand it because his income was less than 50,000. And I was like, okay, there has to be something going on. So I asked him to send me the letter, forwarded the letter to me. We scheduled a meeting and we did a one-on-one. So come to find out, he has a W-2 that he made about $30,000, and then he has a little bit over $20,000 in uh, income he made from Uber and Shift. As a Shift, Uber, just driving around. And then the problem is he didn't think it was really necessary to report that. But Uber and Shift sent the money
Lyft.
to the
I think
IRS.
it's Lyft, right?
Is it Lyft?
Yeah,
Yeah,
Lyft.
Lyft. Yeah. Thank you. I appreciate that. Uber is the one. I actually have done Uber before. I've done Uber many years ago, but I loved it. But I think Lyft, I never did that one. So they sent him a bill because when they report to the IRS, what people don't know is that the IRS takes that information, they report it with your social security number. So Lyft, Uber, or whoever you work with, regardless of the app you are using to make money, they will send a report because that's how they can deduct that from their taxes. They send a report to the IRS. Then the IRS will match that social security number to your number. So when you file taxes, they are very slow. The IRS is very slow. When you file and you don't show that income, or they see that the number they reported is different from yours, if the IRS finds out that you owe the money, they will eventually get back to reconciling. They will send you a letter. And because the letter will come after April 15, there's always going to be a penalty. He had about $650 in penalties. And then they charge about 10% interest, and the interest accrues monthly. So the IRS is very strict on that. And then, so when you see the letter, you see the actual amount you owe, the penalties they are charging, and the interest. And then I told the gentleman, like, the first thing that he missed was not recognizing that he would have to report that money. But the second thing, which I think is more important, is if he had realized that he had to pay taxes on that money, he could have planned it so much better that he would have saved way more than what he has to pay to the IRS. In fact, just by not reporting, he missed applying, being a business, having a Schedule C, and then being able to, deduct some of the key expenses that comes with being a business owner, and then treating it like a business owner. A lot of people know this, but you have to also be careful because on the other side, I have a business owner, a Schedule C person that has been audited by the IRS. Prayerfully, nobody here would ever go through that experience because it's very tedious. And in that audit process, see, that business owner did not report, or even if he reported, he didn't have good documentation. And when they start writing you back and forth to do an audit, that can become a very stressful process. And because of that, when you fail the audit, they calculate everything back, and he had to pay over $24,000 to IRS. This is a different person. The audit is a different client. But those are two different examples. One did not report and ended up with a $7,000 bill. One reported but misreported and ended up with an over $24,000 bill. Sometimes through our tax resolution services, we offer tax resolution services as well. We are able to sometimes waive some of the fees, help you clean up some of the bills, but a lot of times it's too late. So the best time is to plan ahead of time, okay? So that I just want you to understand that, to have that in mind as you start to think about taxes, because the average person that I sit down with, I always when I do consultation, the average person that I sit down with to plan for taxes almost always puts themselves in a position to save money. And I'm talking about thousands of dollars just by simple, legal, allowed, tax sheltered investments or things they can do to really help them save money, and yes, they'll be able to also put themselves in a good position to plan for their taxes. And then it doesn't take a long time, but it really helps you financially avoid paying or increasing your refund. I know people love refund. Increasing your refund is another way, but the truth is, unless you are getting child tax credits or some of these earned income credits, most of the money you receive is money you've already paid to the IRS. And I just want you to think about that. 99% of the money you receive, unless it's a credit, like education credit, child tax credit, all the money the IRS will give you is money you've already paid back to them. So the question is, do you want the IRS to hold your money for a year and give it back to you, or do you want to keep your money yourself? But that is a little bit more detailed than I want to go over today. So I just want you to keep that in mind. So I always group taxpayers into these three major categories, okay? The W-2 taxpayer, that's somebody that works at a normal business, receives a W-2 at the end of the year. And then we have the small business owners. Most of them are self-employed, or sometimes they are S-corp. And then we have the corporations, okay? So we have the W-2, the small business owners. Some of them are W-2 and a small business owner as well, but they are small business owners. And then we have the corporations. Those are the three major tax, I'll call them sections, I section them into these three major buckets. And of course, you can look at it from many different angles. But I do this because when you think about tax saving, tax sheltered systems that you can use to save money, you can really take advantage of some of these things. I preach savings, it's important to save. But if you can save money and save it in a way that is not taxed, that's even better, right? So you think about 401k, you think about your health savings account, that's your HSA, which you can use to spend on any health related activity. I'm telling you, a lot of people underuse their HSA, right? If you think about vitamins, I have kids, so a lot of the things that we use for kids' health, they are glasses, things that you spend money on, you wouldn't think you can use HSA. For me, anytime it has anything to do with health, I use the HSA card because this is money that has not been taxed. So that money on the HSA card has no tax implication and it will never be taxed. So I like spending that for household items that are related to health. So the HSA card can be stretched more than you think. It's not only for hospitals, it's for other health related expenses. Okay. The IRA and then the 529 education plan, those are ways if you have kids, if you want to invest in the education in the future, that is one way you can go. IRA is a great way for people that have good amount of income, but you want to shelter a portion. That I think the IRS give you up to 6,500. I need to double check that number per person. If you are married, that number doubles. So you can use those to save money. And all of these things I've highlighted here, the 401k, the HSA, the IRA, and the 529, they do not get taxed, okay? They do not get taxed. So you can always shelter them. Sometimes, for example, the 401k, let me explain this well. When you invest in a 401k, the money you are putting into the 401k has no tax as at the time you put it in. The growth of the money, so you put 1,000 in, the money grew to be $2,000. The extra growth is the extra 1,000 that they grew by. That is also not taxed. So when you retire and you are drawing the 401k, all of that money is subject to tax. That's really important to understand. When you do an IRA most of the time is money. So I'm talking about Roth IRA, ROTH IRA. It's money that your employer has already taken the tax out. You've already paid taxes on that money. And now you're putting it away for retirement. So that money has already been taxed, but the growth of the money has not been taxed yet. So meaning if you put 1,000 in You put 1,000 this year for your IRA, or let's say 10,000 for your IRA, and then next year the IRA is $11,000. That extra 1,000 that you gained has not been taxed yet. When you go back to withdraw your money, because that 10,000 was money that has already been taxed, the IRS won't touch it. But the extra 1,000, they'll tax it because that extra 1,000 is what has not been taxed yet. The benefit of the IRA is your money will grow tax free, because even when you have stocks and all of those things, as you buy and sell stocks, as the money grows, you pay taxes on the growth. But for an IRA, it can grow tax free. That's the key difference. Okay, we can ask more questions as we move on. So for small businesses and partnerships, the key is there are some tax sheltered strategies that you can use to save money. If you have a small business, the self-SEP is called Simplified Employee Pension. There is solo 401k and there's SEP. SEP is if you have like a partnership or a corporation, you can have a SEP. But when you do a SEP, if you have employees in your business, even if regardless of the business you run, whatever benefit or whatever amount you have for yourself, you have to give the same benefit to all your employees. And the financial advisor you work with on this SEP will explain it to you. But this is for people that run their own business and are looking for ways to save money on taxes. SEP is a great way to contribute. It's like the business owner 401k. You can do your own 401k where that money you put into the SEP will not be taxed. And then solo 401k is for people that are individual. Now, for solo 401k, I had a client, and this client saved thousands of dollars, I think over $7,000 each year, because when you have a business that makes 50,000 or more, that money is subject to close to 23, sometimes 30% taxes. That's a lot of taxes. So 50,000, 30%. Now you are looking at what? Or close to 15,000, a little bit over 15,000 just on taxes. But if you go through the solo 401k, you can put all of that money into the solo 401k and then it will not be taxed. Okay. It's like a 401k, but for self-employed individuals. So that is also out there for people that are looking for strategies to save money without, if they are self-employed. And of course, you have the IRA and then the real estate. The real estate is very technical investment, but real estate is one of the best ways to invest money and then create a tax shelter around that. And the details of that, I typically like to go over it one-on-one because each person is different. But one of the strategies, if you are somebody that makes quite a bit of money, you do well with your business or with your company, and you're looking for ways to shelter some of your investments from taxes, you can leverage a real estate business really well, better than most other businesses that I know. Okay, so that will be something for more detailed discussion. So as we go on, if you have questions, you can ask. Okay, so W2 small businesses and business owners, those are the three major categories that most people fall under, right?
Okay, Kwame.
So,
go ahead, proceed.
No, go ahead if you have a question. I'm
Yeah,
okay.
so I was trying to find out about how like with I'm just going on the individual tax filings. You know how sometimes people file taxes like, oh, my main for being my main for being too so bad now what are implications to that? Because a lot of people think say it's a freeway journey, but there are so many things that can come back and bite you in the future. What are the implications to that?
Yeah. Well, first of all, fraud is very important. Identity fraud is key. Right now, there's so many things. So for those of you who have business, I don't know if you know this, even now, if you register a business, they require you to show identity to confirm that you are an actual person. The IRS has now digitized most of its filing processes. So if you are going to put somebody as a dependent on your taxes, you have to be very thorough with that, because if you are not a primary parent, there's a lot more questions. And every taxpayer, you are required to do due diligence. There's a whole due diligence sheet for that. They ask you a series of questions, so about 15 of them. A lot of people may skip that over, and technically, because the IRS, you're dealing with 300 million people, over 300 million people filing. So some of these things can slip through the cracks. But whoever they get hold of, that can become a very big problem. So if it's not your child, you have to be very thorough in how you claim the person. You can't claim somebody that's not your child. It's legal. If you are the person providing over 50% of the
50%.
person's expenses, and then they live with you, you can legally claim them as a dependent. Okay. And then especially if they are under 18. But you have to be very mindful of that, because number one, if they are not your legal dependents, someone may be claiming them too. And then two, you have to make sure that the questions and the things you have proved, it could be education, like paying for their school, hospital bills to prove that they live with you, have something to prove that this person lived with you over more than half of the year. Now, you may file the taxes and the IRS may never come around and ask you, but there have been situations where they will write. I have seen that firsthand before, personally, where they'll write to you and say they want to see proof that this person actually lived with you and that you provided more than 50%. And that can be very stressful. And the moment they go back and forth with you, a lot of people don't know this, but they'll go back and forth with you, and it's time, right? So you get a letter, you write back, or you call, you write back, they take another 2 weeks, they send you another letter, and then after 3 months, they say, we still want you to pay us back. Then they will go back and calculate all those penalties. Most of the time, the penalties are even more than the taxes you owed at the beginning. And if you have anything over 10,000, then it becomes fraudulent. That can get you felony charges. So those are things that you have to be very mindful of. So that would be my answer to that.
Okay.
I don't know if it was clear.
And Asundip asked the question. He says, so the guy in your example who had a W-2 and did a ride share, under which category would he fall?
So the guy in my example who had a W-2 and did what?
A ride share.
Ride share.
So he wants to know, he or she wants to know under which category would he fall?
Oh, that's a Schedule C. That is a Schedule C, I'm sorry. So that is a small business, right?
Okay.
That is a small business. It's a Schedule C. So that person, Schedule C, you don't even have to register a business to file a Schedule C. As long as you're doing anything, making money as a contractor or getting paid as a contractor, you can file for Schedule C. The moment somebody pays you, that is not a W-2. You are a business. That's what I call it. You, the person, becomes a business. And you have to think about that. This is why that is so important. The moment you think as a business, now you can think of every single cost that you incur to earn that income. Okay? Every single cost you incur to earn that income. So the Uber person, they were a business the moment Uber started paying them. So they could have said, well, I had to drive this car to do the Uber, the gas, okay, the phone that they are using, even the internet. You can go as far as saying even your app, your laundry expense, because you have to dress nice to sit in the Uber to drive people. There's so many ways you can be strategic with it. But that is if you are planning it so you can keep the receipt, keep the accounting, keep everything really well aligned. So when you submit it to the IRS, even when they question you, all your documents are in place. That is why planning is so important, because you can be very strategic in a legal way with the cost that you add on to even being a self-employed person.
All right. Thank you.
Okay. Thank you for the questions. I love it because it makes me know that I'm actually communicating, and then it helps me really go in the direction that the people want to hear. So I always want to, for the tax portion, this is the last thing I'll say. The best time to plan your taxes is before December 31st. So what I tell people today is this is the beginning of a new year. Last year might be too late for some of the things you wanted to do for your taxes, but it's not too late this year. So you can go ahead and start planning for this year. I also share this website, tcbtax2023.com. I share this link because this is the link for anybody that is looking to work with my company to file taxes. You go on the link, it's a simple questionnaire, you go through it, and then we will be able to run you through the process. It's a very easy way. We do taxes for people all across the United States. And then you just go on the link, you fill out the forms, and it will be in touch with you. And then if when we reach out to you, want to do a one-on-one, you let my admins know, and then we will schedule a time. It could be Teams, likely it's going to be on Teams, and then we do a one-on-one where we help you really look into your taxes and give you strategies and systems to save money moving forward. It's a very important process because a lot of times people that plan for their taxes, especially ahead of the year, almost always save money. So that is the information out there. TCB Tax 2023. TCB just means Tri-City Business. So tcbtax2023.com. All right, home. Okay, shifting gears. Remember, you can ask me questions anytime, and you can go back and ask questions all day too. So, home purchase. Now, just before I start, I want you to know that I bought 2 homes. Okay, my family bought our first home. I remember my first mortgage, and I tell this story so I can jump into the strategies. When I bought my first house, the process we started in November, we closed around 2nd week of February, I think. So that was the length. Then 2 years later, I bought a second house. The second house much more expensive. It was way over even it was a bigger amount, about 5 times the cost of the first home. We closed in 1 week. And the strategies that I used to close is everything I'm going to share with you. I closed the house from the day I initiated the loan, or I contacted the loan officer, to the day we closed and signed the papers was just exactly 1 week. And it was because I was way prepared. I was fully prepared. Now, I'm not a loan, I don't make loans. I'm not a loan, what do you call it? I don't offer loans to people. I'm not a real estate agent and anything like that. But I share this with you because I think when you are well prepared, it makes getting home loans very easy, especially if you're a first-time home buyer. But the most important thing is just doing it, okay? So buying real estate is, this is a quote from Marshall Field. Buying real estate is not only the best way, the quickest way, the safest way, but is the only way to become wealthy. That is just a quote I picked online. But the goal is that I want to share these 5 key takeaways. Think about them as you plan the mortgage, because not only does it work, it's the standard in the industry. So this will work wherever you are. So the first thing I want to talk about, savings. Okay, whenever you are planning to buy a home, number one, you know about how much you want to spend on the home. Okay, so you have that in mind already. You want to begin to save the money, and that is why I think if you can plan 2-3 years ahead of time, you want to save the money. If you're a first-time home buyer, you know that your down payment is always going to be between 0 and 20%. Always. There are programs that are 3%, some are 5%, some are 20%, some can go 15%. You can put as much as 50% down if you want to. But for your savings purposes, try to save within that amount. Definitely don't go 0. What I recommend you do is try to save that 20%. Just make that your goal. Try to save that 20%, because the best thing is when you get there, it will be easier to have more than not have enough. When you get to the place where when you get ready to apply for the loan, it will be so much easier to have more than you need than not having enough. So the first thing is save. That's That is at the heart of it. What people do, and I've seen it done so many times, is they know they want a house, they find a house they want, they don't have enough money, then they go borrow money from friends, or they go ask family and friends to give them money. When you go to a mortgage loan officer, they want to know not only the source of the money, but that money has stayed with you for a period of time, minimum 3 months. So they'll look at that savings and go back, they'll look at statements that go back 3 months or beyond to make sure that you just didn't bring that money into your account. So you cannot go and then say, okay, I found a house, I need 3%, I need 5% down, and go borrow money to put on there. You can't do that. They will always want to go back and find out how you got that money. So the best way is to plan ahead of time. Like I say, if you can plan 2, 3 years, 10 years, it doesn't matter. Just save money knowing that you are getting ready to buy a home. Now, your closing costs will also be about 3 to 5%. Closing cost is the cost when you are ready to close. It's not part of your down payment. Your down payment is for the loan. Your closing cost is just what you pay the title companies, you pay all of these legal institutions to close on the home. That is about 3 to 5%. So putting the closing cost together with your down payment, you are looking to between 10 to 15% minimum if you're a first-time home buyer. If you are not, then you need to think even more. Okay, so I see a question here, but it's taxes. It will take me back. So if you don't mind, let me move forward and I'll come back to it. Okay, and then I'll answer that question. But so that is the idea. Save enough to be able to close on a home, so that when you are ready, you can have your down payment with your closing costs more than enough saved for that. It's the first step to home buying. Now, the second step, which is also as important, is your income. So a lot of people don't know this. When you're ready to buy a home, people think that it's your credit that determines how much they give you. That's not true. It's the amount of money you get qualified for has nothing to do with your credit. It has everything to do with your income. So your income is important. So they look at your income and then they calculate your payment towards the home. Most banks are comfortable with numbers under 30%, under 40%, which means the cost of your mortgage plus all the insurance and everything is under 40% of your total monthly income. They don't like to see a loan where the cost of your mortgage is more than 40% of your income. So your income is really important to determine how much you qualify for the mortgage you are going in for. Okay, so and with the income, they are always going to look back 2 years, always, because they don't want to give you a loan if you just started work. They want somebody that have been gainfully employed consistently over a 2-year period. That doesn't mean you've been at one job for 2 years. No, you could be 3, 4 jobs. It doesn't matter. They want to see that you've been working consistently for 2 years without any major gaps. So a gap is what I call a month or more. So anything less than a month, you're golden. Sometimes, I think all the time, they would allow schooling or being in trade skill training as part of your time. So let's say you worked for 3 months, you stopped, you went to school and came back and then and then you had, let's say, a year gap and you came back and you started working. They will allow that. They are okay with that. Or you were schooling for a year and a half and then you started working 6 months ago. As long as you can prove that you're schooling for a year and a half and you just started 6 months ago, they would allow that too. So that essentially, that's what I mean by gaps. The gaps are key, because if you go apply for a mortgage, let's say you are in a job for about a year, but you're 3 months before that year, you were not working, then that begins to get more difficult for you. They need something to explain why you have that gap. So 2 years of gainful employment to prove that income. It can be business income too. Mostly with business income, they will use your tax transcripts, meaning the taxes you filed has to be consistent with the income you tell them you are making. And that is what they will use to determine whether you have enough income to qualify for the money you are applying for. Okay, so you can use business income, but remember, with business income, they use your tax transcript to prove that your business income is enough to pay for the mortgage. They focus on your income to determine how much you are approved for. Then you go to your credit score. Now, the key to your credit score is, remember, credit is really telling the mortgage companies that you are a credible person, that they can rely on you to pay. So that's essentially what you are doing. The key to your credit score is it helps you with the cost of the loan. And I always use this. I think I went over this last week. The credit is just letting them determine what it will cost you to get that loan. And the cost of your loan is always the interest rate, because the interest on the loan is money you are paying only to the bank. It doesn't come to, it has nothing to do with the money they are giving you. It's the interest on top of the money you are borrowing. And the more your interest, the more you are paying. It's a very simple concept. When you have anything below 620, it becomes a little more difficult. There are programs that would allow lower than 620. Don't get me wrong, but it becomes harder. 620 and above, you are likely to get one. Avoid collection at all costs. If you're going to be applying for loan, clean up any collections you have on your credit. That, because the moment you have a collection, you are telling the creditor that you are comfortable with not paying a debt. Mortgage, you don't want to have those kind of things on your credit, because they just prolong the process, or they can even let you lose the loan. So 620 or higher. I believe 740 credit score is an ideal place to be, and more, because at 740 and above, you are likely to get the lowest interest rate available to you. At 740 or higher, you are likely to get the lowest interest rate available to you. So if you can hit that number, you will be good. And that is where you begin to now get, now interest rates are already high. It's really high. There's a hope that this year interest rates will come down. So as it even comes down, it's more beneficial to have a good credit score. So these are things you have to work on ahead of time. Cleaning up your credit, making sure you avoid any collection, putting all your credit cards, spending your credit cards, not spending more than 30% of your credit cards. So you keep your credit balances very low, especially the revolving ones, having less debt. Every debt you have is going to go against your income, as I covered here under the income section. I remember I told you your income determines your loan. The debt you have outstanding goes to reduce your income available for the loan calculation. So reduce your debt as much as possible, so your income will be more significant for the loan calculation the loan that they will allow you to borrow. Okay, so the goal here is to have the highest credit you can have, so that you can stay within the lowest interest rate. But your credit is only to help the interest rate. It doesn't determine the amount of money you can borrow. I hope that sinks in, because a lot of people believe that when they are going for home loans, because they have good credit, that they can get approved for more money. That is not the case. It's your income that determines how much you get approved for. Okay, now the last two things I want to cover is the loan. Remember, I said 5 things. So I talked about the first 2 is savings and your income. The third thing is your credit. These are the last 2, the 4 and 5. So first thing is, whenever you are going to go on the market, get pre-approval forms. And this is really important. I always get pre-approval from like 2 or 3 places, because everywhere you go to get a pre-approval, they run your credit. And when they run your credit within a 30-day period, for as many times for the same purpose, it counts as one hit. What that means is, if I go to bank A and I want a loan and they run my credit and then they tell me what I am approved for, then I go to bank B and they run my credit within the same 30 days, and I go to bank C and I go to bank D for all of it for mortgage, they all count it as one hit. As if you do it for different loans, it's not. If I go bank A to do a mortgage and I go do an auto loan here and I go do a personal loan, that does not work like that. All of that will be counted as independently. So that will be 3 different hits. But if I go to bank A for a mortgage pre-approval, bank B for a mortgage pre-approval, bank C for a mortgage pre-approval, all within a 30-day period, that counts as one hit. So the strategy I always encourage people to do is go to as many as you can within that short period, and then pick the best ones based on customer service, is to talk to the loan officer, people that are more personable, and get at least 2 or 3 pre-approval letters. I always want to have options, because it's one of the most beautiful things to do is to pit different lenders against each other. When I go to bank A and I tell them, well, I just got a pre-approval from bank B for this amount, now they are thinking, okay, this person is already worthy. This bank is going to give him, then they said, okay. So now they are trying to undercut the interest. So you do the loan with them. One thing you have to know, banks, the way they make money is when they give out loans. They make money from loans. But a lot of times, because we go there without being very credible, we feel like the banks don't want to give loans. No, they actually really want to give you a loan. So strategically using different banks can help you really even get to a lower interest rate. And some banks will do that. So the first thing is making sure that you're in a good place so that when you get multiple, then the second thing is that helps them speed up the process, because banks can be very slow. But when they know that there's another bank that is already ready to give you money, they speed up the process. Okay, so if you show them a pre-approval letter, I go to bank A, I get a pre-approval letter, bank B, I get a bank C. Bank A knows that I have pre-approval from B and C. Bank B knows that I have pre-approval from A and C. They are all working really fast because they don't want to lose the business. That's really important. That is one of the strategic ways you can get a lower interest rate and you can get speed in how you get your loan to work out for you. Okay. And then the last thing I'll talk about with the loan is when you go for the loan, the pre-approval, and then the final approval, the closing. This is what I want to share. Always close with a bank that you can talk to the loan officer. It's so important. I don't deal with banks that I have to personally call 1-800 number just to talk to the loan officer. When I do a business loan, when I do a mortgage, I don't do that. All my loans, business, mortgage, it doesn't matter. The person that gave me the loan, I can always call them on their cell phone. It's so important because the little things of being able to call somebody can make a world of a difference. When you are dealing with these 1-800 numbers, it becomes really headache. So if you can do with your credit union, if you can do with your local bank, if you can do with a local lender that you can relate with, those are the people that they are not looking at numbers. They are looking at you as a person and making a decision on you, not looking at you just like a number. Okay, so that is a preferred way to go. That is not the only way to go, but that is something that I tell all my clients to do that. I highly encourage it because so many times the people that get into trouble, sometimes foreclosures and stuff, one of the reasons is they don't even have access to their lender. So they are not able to really talk to them when things change, and you have to talk to them about maybe giving you a break and everything. When it's a local person, it's easy to go to them and have that conversation. And sometimes they're able to even help you, they're able to direct you to programs and everything. And then also when it comes to lending, there's so many different programs out there. There is the FHA. Most banks have all of that. The FHA, the US, the HUD kind of program for first-time home buyers, for people buying houses in rural areas. Now, rural in America is different, right? You can be in a place like in Saginaw, where I live, is not as rural, but part of Saginaw qualify for the rural program, which is really good. So it's just go and then put in your zip code on the website, the HUD website, and then they will let you know whether you qualify for the HUD program. And the details of it is out there. Just look HUD program for first-time home buyers. You will find it. So with that being shared, one of the other programs out there that most people don't know about, but some people do, is called NACA, NACA, NACA. So the NACA is a very different kind of a mortgage lender. It's backed by Bank of America. They don't give you a loan based on your credit. They just use your financial history. They have like a 10-step process. It's very robust. But if you go through NACA, you don't pay any down payment. And then you don't pay any closing costs. They pay all of that for you. You can use them to refinance your home. You can use them to do so many things. But their process can be very long, but it's the best, I think, mortgage program out there. It's just that if for speed, that one, if you want to get it done quickly, NACA is not your option. But if you are somebody that financially or credit-wise you struggle a little bit, NACA is ideal. They are really good, and then they can help you really get a loan and a mortgage. And they also make sure that the house you are buying meets a certain standard. So they are very thorough. I think they are one of the best ones out there for those that need more hands-on help. Like I said, it can be a prolonged process. Sometimes NACA can take unnecessarily long, but they are a great program. NACA. So you Google, you go to YouTube, NACA Home Mortgage, it's out there, and then you can use them to also get your home. So the last thing I want to share with you is when you get approved for your home, three things will happen. Okay, when you get approved for your home, the bank will send out an appraiser to go and appraise your home. Three things is always going to happen when they go appraise the home. Number one, they will do an appraisal, and that appraisal will be equal to the amount of money you are asking for. So let's say you're going to get a home, $200,000. This is the home you're going to get is $200,000. You go, the bank approves you for $200,000. You have your down payment, your credit is good, everything is perfect. You are ready to go. The last thing is now you find a home that is selling for $200,000. The seller wants to sell you the house. You sign a purchase agreement. You are good to go. The bank will send somebody to go and appraise the house. The appraiser can come back and say, yes, the house is worth $200,000. The bank will give you that money. You are okay, no problems. The second thing that can happen is they can do the appraisal and they can come back to you and say, well, you're asking for 200, but the house is worth $300,000. So they've appraised it more than what the bank is willing to give you. In that case, it works for you. You can do so many things with it. You can use that to negotiate your closing costs. Means you already have equity in the home. So you can strategically do different things with that. So that is a good thing. But the last one is the most challenging part. That is, if the appraisal falls below the amount that you are asking for, you have 200,000 approved, you go, you have the house, you sign a purchase agreement that says you want to buy the house for $200,000. That purchase agreement is a legally binding contract. The moment you sign that purchase agreement, it's legally binding. So if the house comes back and then they says the house is 150, the bank will say, well, even though you are approved for 200, we will only give you 150. Now, that 150, you have to come up with the extra. You have to come up with that $50,000 cash. So it's really important that you understand that process, because a lot of people when they lose homes, sometimes it costs them money, and sometimes they mess themselves up because always the appraisal comes in lower and it can destroy a deal. So before you buy the home, you have to be mindful of how you think, and getting a real estate agent helps avoid all of these things because they know the market, they know how things are priced, they understand it. So having a real estate agent, a good one, that only represents you, the buyer, is able to help you avoid those kind of pitfalls. So with that being said, any questions, any thoughts? That's the heart of my message that I wanted to share with you. But before I open it up for questions, I want to go through these questions first. It says let me start with the tax one. Upon filing marriage,
Nana, can you hear me?
joint.
Nana, can you hear
Yeah, I
me?
can hear you.
Yeah,
Yes.
before we go over there, let me go ahead and ask you two questions, and after that, we
Yes.
can go through the questions on Zoom. Then we're gonna open the Zoom line for people to actually unmute themselves and talk. So I have one question to ask you. The first, I mean, I have two questions. The first one is basically, we have the FHA and the conventional loan, right? Which one will you recommend people to go with among those two?
Okay, so FHA, so Federal Housing Authority, FHA basically created a program for first-time home buyers, saying that the conventional way, the bank typically wants you to put 20% down. The credit score sometimes are a lot higher, and then they want to make sure everything is good because the bank is in there to manage their risk. They don't want to give you money that they can get back. So they are very big on keeping them from losing money to, because the bank doesn't sell homes, so they are not interested in foreclosure. Actually, banks will do everything they can to avoid foreclosure because they lose money too. So what the FHA did was they came in and said, well, we want to create a program for young people that want to buy a home that may not have that 20%. Because if you want to buy $100,000 home, that is that is $20,000. That's a lot of money for most people. If you want to buy a $50,000 home, that's $10,000. So the FHA said, well, we want to create a program so people can buy a home with as low as 3% down. So now think about it. If you want to buy a home for 100,000, you have to have $20,000 saved for down payment. Now that 20,000 becomes only 3,000. That's much more achievable. Or if you wanted to do the $50,000 home, instead of having $10,000, now all you need is 1,500. Some go as low as 0%. So it's a program to help first-time home buyers. So with that being said, if I am a first-time home buyer, I would want to take advantage of that. And one of the strategies I always tell people is, so the FHA is always good, especially if you meet all the criteria to go conventional and you go FHA, then you have more cash to make a decision with it. You can do two things with your cash. You can buy the interest rate down, or you can pay more out. But this is what I recommend, and this may be a lot technical, but follow me. I'm going to buy $100,000 home. Conventional, I have to put 20,000 down. FHA, I have to put 3,000. I do the FHA, I put 3,000 down. Now, in the records of the bank, I have a loan in my name of $97,000 instead of a loan in my name of 80,000. So that means that if I have a loan in my name of $97,000, then right after the loan is approved, I close. I take that 17,000 and I pay off another 17,000 of the loan. So essentially, I still put down the 20,000. But what I have done is I have now shown a track record that I was giving 97,000 and I've paid it down to 80,000. That actually is better on your credit because this you can prove that you have the capacity to pay off a loan. So I'll still go the FHA if you qualify, just because they will give you lower interest rates, they will protect you, it's more security, it's a little bit more strict, but it's better if you can than the conventional. And then whatever extra money you have, you can buy down your interest rate or pay off some of the principal because the interest is only charged on the remaining principal. So if I have $97,000 and I'm paying, let's say, 700 a month, that interest portion of that 700 is only charged based on the principal. So if I pay the 17,000 down, the interest will go down, and then more of that $700 will go to reduce my principal. So that is easier to explain that with math, but I hope that makes sense. But
Okay.
to answer your question in simple terms,
Yes.
FHA should qualify for it.
If you're a first time owner, home buyer. Okay, so
Home
my
buyer,
second
yeah.
question is on the fact that we just talk about taxes, right? So there's a lot of things that people don't understand when you own a home and your first time filing taxes for your home. There is a credit that you can get for, owning that home.
Yeah.
And every year when you file for taxes, can you break it down a little bit, or can you go a little in depth on that so that people can really
Yeah,
understand
it's
some of the
actually
benefits of owning a home?
okay. It's actually the mortgage interest, right? And I think what people sometimes miss is, so I was going to go over this, but I didn't want to get too detailed on the numbers. But your Form 1098B, so mortgage interest. So what I want to share here is that when you think about the interest, right? If you are getting a mortgage interest, and I'm going to find this for you. When you are getting a mortgage interest, normally when you buy a home, part of your closing cost is the interest payment for the rest of the year. Okay, so what the bank do is they prorate your interest and your home taxes and all of that. And so because you are paying interest, that interest, number one, because you are paying a chunk of your money at the closing cost, that interest does help you on taxes, because the more interest you pay is the mortgage interest payment that you get tax deductions on, and you don't get the whole amount. You get a certain deduction based on the amount of interest you pay, and then each year the bank will issue you a 1098 for the mortgage interest, and then that interest will keep giving you tax credits. The calculations is a little bit more complicated depending on who you are, because that interest can also help you save more money if you are itemizing versus you are doing standard deduction. That the mortgage interest is part of the itemized deduction, and there's two types of deduction that you get in the US, and so let me show it here. So and a lot of times this confuses people, but if you look at this is called a standard deduction, right? You get this amount, everybody that files. This year is $13,850. You can get the standard deduction, or you can itemize. When you itemize, you only itemize if you can get
What do you
more
mean by this
itemized
year is
stuff.
13,000? Every homeowner gets 13,000.
No homeowner, every single person, every tax filer gets 30,000 of their income right off the top.
Okay.
But you can get more depending if you itemize. If you itemize and your itemized deduction is lower than 13,000, then they'll give you the 13,850. But if you itemize, and let's say you have a home where the interest payment is high, you have hospital bills, you have different things that your gifts to charity, different things that makes your itemized deductions higher than 13,850, then the IRS will take that number instead of the 13,850. 90%, that 13,000 is so high. 90% of people do not itemize. Okay, the itemized deduction is called Schedule A. So let me put this Schedule A. So this is if a person decides to itemize, right? So, and forgive me if it's a little bit technical, but just so you understand. So if you look here, see how it says interest you pay, and then right here it says mortgage interest and profits.
Okay.
This is where your mortgage interest comes. So they look at the total of this total itemized deduction. They look at the total of this number, and then they compare it to this 13,850. And if the total of this number is less than 13,850, then they give you the 13,850. If it is more, then they'll give you that. A lot of people don't have enough items to make this, because think about it. If you give cash 250 or more, then you can get it, but you don't get everything. You get up to a certain percentage of your income. There's a lot of nuances to this that gives you the total number. So they compare the itemized deduction to your standard deduction before they make that decision. So that's why it's always important when I tell people, if you're a first-time home buyer, yes, you can get a benefit from that, but you also have to understand that a lot of the benefits for first-time home buyers, some of them fall under the itemized deduction, and that if it's less than the standard deduction, then it doesn't really help you because everybody gets standard deduction. Every single person that files taxes.
Okay. All right. So let's go to AB's question. Thank you. So AB says, upon filing marriage joint, my wife and I had to pay IRS $6,000 last year. Assuming we made the same income this year, is it advisable to file separate or jointly?
It's high probability you probably owe the same or even more. It's very unlikely, unless very unique situations, that you file separately and pay less money, especially if you're in the same income bracket. So filing jointly always makes sense. It's rare to see people filing separately and see them save money. What happens that a lot of people get confused on is, let's say they decide to file separately. Because one spouse income is very low, they may get a refund. But then because one spouse income is high, then their tax liability shoots up. So then if you net the two, they are always in a worse place. So if you and your wife spend your money together, then you may end up in a worse place. So, but you can always test it. If you are filing, this is what I always do. If you're filing and you want to test it, you can tell your tax preparer, or can you do it with separate to let me see the impact before you do a joint. And sometimes we can even run the analysis for you to show you, if you file separately, this is how it looks like. If you file jointly, this is how it looks like. So you can always run the analysis so you see the impact.
Okay. Then we go to Selwyn says, why does your credit take a hit when they ran it?
That's a great question for the credit bureaus. We just know that it does take a hit, but it's not as bad if it's not done multiple times. If it's one, it takes a hit for a short period and it comes back. Like I said, if you run the same thing over the same period of time, it only takes a hit one time. But I honestly don't know the answer to that question, but I guess they want to use to prevent people from just running their credit and trying to get loans. It doesn't have such a major impact if you don't just keep running it over and over again. If it's once in a while for major purchases, it's very cool. So
Okay.
you can let it breathe and without really stressing it.
A Sunday goes, after the pre-approval, for how long will it remain valid before you get a loan and use it to purchase the house?
No, well, the pre-approval is the bank telling you, based on our analysis of your finances, we are comfortable giving you $200,000 or $300,000 or $100,000 or $50,000, whatever the bank has on the pre-approval. So that is essentially them telling you, you can be approved for this amount. It's only subject, normally the pre-approval is subject to a few things. Number one, that the house you are buying will match the price. I already talked about that. Number two, a lot of times they give you the pre-approval without first sometimes inspecting your income documents. So the income, the 2 years income that I talked about, your taxes, all of that have to be good. So they are giving you the pre-approval based on just running your credit initially, and then based on what you tell them. They don't get the documents yet. You find the house now, you're going for the real money. Now they want all these documents to support what you told them to give you the pre-approval. But if all of those are well documented and well organized, it's done. When I get pre-approval, I give them all of those documents ahead of time. So that the pre-approval they give you is almost like an approval. It's like a final approval because they have every single document they are going to ask you for. So the moment you find a home, you go they can close, because now they are not asking you for your W-2s, and now they are not asking you for this history, because they already have all of that.
So
They will
no,
give you the pre-approval without you giving that to them at
no.
first.
I think
Yes.
what Asunda was asking is something I've encountered a similar situation before. So I had a pre-approval for a particular house, and I lost
Okay.
the house because I was the second what is the name for it? Whatever. I was the second builder for the house, right? And the first person went through, so I lost the house. And when I got another house, tried to get a use the same pre-approval for it, the bank told me
Okay.
that the rate is not increased by 1%. So let's say initially if the rate was like 3.5, now I have to go for 4.5 rate because the pre-approval
Yeah.
was tailored to the house. And I had 90 days to, actually it was 30 days. They gave me 30 days to fall through with the pre-approval. And once the pre-approval didn't go through, now I have to come for another pre-approval tailored to this new house. So is this something that they're supposed to do,
Yeah.
or is the bank that is actually making their own personal stipulations to that?
No, I do know that number one, interest rate is always based on going rates. So at the time that you get a loan is when the interest rate is decided. So if you get a pre-approval today and in March you go to close and the interest rate has gone up, they will go, because the interest rate is set by the Fed. So that is depends on the federal government, and then it's also subject to the fact that your credit situation hasn't changed. If your credit situation has changed, that can also impact the interest rate they give you. The pre-approval is always has a limit on it. That is true in terms of how long it's valid for. So some will say 90 days, some will say 60 days. Some banks allow for extension up to 6 months. So there's different banks will approach different ways. That is, so that it's not like a lifetime pre-approval. So before you go in for the pre-approval, it's good to be really heavily looking on the market, because so many things can change between the time you have the pre-approval and the time you get up. That is why they call it pre-approval, because they are proving you subject to the fact that all the facts remain the same, and that the economy hasn't changed, the interest rates haven't gone up. There is times where in the 2020s, 2020, where people got a pre-approval, by the time they went to close, the interest rate had come down, and therefore they were able to get actually cheaper interest just because the rates had fallen. And so that happened to some people too. And there are people too that they got a pre-approval, and by the time they went to close, especially last year and the year before, that the interest rate has started shooting up, and the bank will have to adjust based on the going rates. So that the going rate is not determined by the banks; it's the Fed that determine that. Also, if by the time you are going for you go for the pre-approval, by the time you are ready to close, your credit situation has changed significantly. That so they make you sign a waiver that you haven't applied for anything, you haven't applied for any credit card, you haven't taken out any new loans, because they are giving you the pre-approval based on a certain financial facts that you provide them, right? So I hope that makes sense.
It makes sense, but I think my experience was based on the fact that before I even had an offer letter put in. So some realtors will not let you go look, or some homeowners or sellers will not even let you come look at their house unless you have a pre-approval letter. So mostly what
Yes.
people do is they get a pre-approval letter and start house hunting. So whilst they are
Yes.
house hunting, they got a pre-approval letter of, let's say, $800,000 in the hand, looking for a house between 600 to 800. Now, you go over there, put in your offer letter, and you bid for it, and waiting, let's say you put it on Thursday, waiting on Monday for you to, be for your realtor to get a call saying that, hey, we selected you guys and this is our counter offer, or we accepted your offer. Then it comes back like, oh, you know what? We chose this guy over you. Because this person was the
That
first,
happens a lot.
exactly. You know,
Yeah.
that is what I was talking about. So in that case, when you lose on that house, not because you already started the process, you are waiting to get an offer letter for both parties to just go into an agreement, then you have that 30, the 30 days to go ahead and close and start doing all the communities. So basically, once you jump in on another house, I was under the pressure that I can use the same pre-approval with the rate that was given to
Did the
get
rates
another one.
change? The question is, did the federal government change the rates within that time period?
Honestly, the rate wasn't changed, but the dude was like, I have to run it again because the pre-approval was based on this particular house address that you gave me. So when we went for the other one, because the pre-approval was based on, okay, I found a house, I'm about to send an offer letter. I need a pre-approval letter. Got the pre-approval letter, went to go see the house, sending in the offer letter. Then later came back like, oh, we chose somebody over you. Okay, no problem. I need to go find another house. I'm using the same pre-approval letter. Got that house. Now I'm trying to put an offer letter. Can you give me an updated, pre-approval with the date of the new house on it? I was like, oh no, I have to run it again. Then when he runs it again, it goes up by 1%.
So I don't think it's normal for a bank to just go up because you're using a different house. Because I don't think that
didn't make sense at all.
Interest rates. Yeah, the only thing that can affect the interest rate is either the credit change or the federal government has changed the rate. I don't think that the switch of a house should affect the interest rate at all, because the interest is not based on the house you're buying. So that's a little bit. So I would ask for more detail, but it is what it is. Every bank has their own rules.
No, I had to change my bank because of that, because it didn't make sense to me.
Yeah.
And that takes me.
That's why I like to pit banks against each other when I'm applying.
And that takes me to my second point. So, I was selling my old house, and I was having problems selling the house because of appraisal. So I came across some articles online stating that when a black person is selling the house, and whenever people, like this is a case whereby you have 3 people coming for like, hey, I'm interested in the house. Then when appraisal comes, it's like, oh, it's being appraised less than, let's say the house is 500,000, right? Appraisal comes is like 450. So now it's like, oh, the appraisal is lesser. I'm not gonna follow through with the deal. Then they back out. And I saw this article about how people were making people of other race to front their house, and the appraisal comes up is like 650. And it's like they end up, selling the house because the same house that was appraised for 450 a year later or 6 months later, when a different race fronted the house, the appraisal went up by 100,000 or 150,000, and they were able to sell the house without a problem. Is that something that you are pretty much aware of?
That's been happening based on what I've heard on YouTube, right? And there was a story about a lady, and it looks like a very true story that had exactly the same experience you're having, where actually it was on the news, not YouTube. It was on the news where they changed all the pictures to white families, and then all of a sudden they got a higher appraisal. One of the ways I think that as a community, so for some of you listen, we don't have enough people that do appraise. We don't have black appraisers. Like even where I am, there's no black appraiser. I think those problems would be avoided. But to get the license to appraise a house, you have to be recommended and approved by another existing appraiser. So it's something we as a community we haven't really.
It's hard to break that.
Yeah, but I think it's something that I will hope that we can get 1 or 2 black appraisers out there, so that we don't always have to find ourselves working with people that may not value who we are as a people. But that that's more of a social conversation. But that is, I've heard that happen. Yes.
Yeah, because actually the person that I ended up selling the house to was like, it's crazy to see say the house was appraised less, and he even waived the appraisal. Like, I'm not doing it. And he wanted to go so deep into it to the sense that, and there was like backup bias, right? But he was like, I'm waiving the appraisal. So it was a smooth transition. And up to now, never got a single phone call from this person and say, oh, the house is really not worth what I was looking for. Man, in fact, he's actually excited and happy about it. So sometimes I feel say all this information needs to be told and educated on for people to really know what they're getting themselves into, whether you are selling or buying a house, because
100% agree.
especially when you are doing both at the same time, it can be a little bit tedious and stressful. All right. So with that being said, I'm gonna open Zoom for people to unmute themselves and ask their questions. We have about 7 to 10 minutes before we turn over to the next phase. So
Yeah, Sandeep, and then Asiedu both have their hands up.
okay, Asandip, go ahead. Then after that, Asiedu will come.
This is a Sid. This is a Sid, yeah. I wanted to add a little bit to what you were just discussing. What can be done is when you are about to put your house on the market, you try as much as possible to reduce your blackness. It's very, very important. I mean, it's odd for me to say that, but it's happened to me. You just make sure that the pictures and all those Ekwaba from Ghana and Nigeria, and if you put them away, because it's worked for me. So I just wanted to give a suggestion.
Thank you very much. Before you proceed with that, Nana Kwam, can you go ahead and stop sharing your screen so that we can have you the full
Okay.
for production purposes?
Yes.
All right, cool, beautiful. So Asiedu just gave a beautiful instances, and a lot of people were telling me that too, but I'm very stubborn. I was like, I'm not taking it down. I mean, if you're gonna get it, you're gonna get it. I mean, at the end of the day,
we need black appraisers and all that. We are not there yet. So what as individuals, what we can do to help ourselves and our community is to do that. It's very painful, but
no. I said, I totally understand. You have a very. I didn't take it down. I chose not to. But I'm not saying people shouldn't take it down. I'm just saying that this is me. This is my identity. I'm the owner of the house. If you have a problem me owning the house and for you to buy from me, I'm sorry. But again, like I said, when it comes to my background and stuff like that, I'm very stubborn with it. So I kept it. And at the end of the day, I had it was a white person that bought the house. It was a white neighborhood. So everybody that came through, 99.9% were all white. And at the end of the day, I had somebody who bought it. One thing I believe in buying house and selling houses, you're always going to find that one buyer for that one particular house. It's just like you try to buy. You know how sometimes you try to get a house, it goes like, wow, this is the house, this is the dream house. Then guess what? You get, like my older brother, Feel Good, who says, you're going to get that mixed feeling all the time. Because you get it, you're excited. The next day, somebody take you off the market with a higher bid, and you are going for like 600. Somebody put 650, and the house is being sold for 575. Or just on the 25,000 or so. Try to make somebody gonna beat you out of it because people are flipping houses right now. So what you're saying, trust me, I feel say if whoever feels comfortable with that, please go ahead and do it because you try to get rid of your house and get to the new one. But maybe I kept it. Sandeep.
Challenge, for people that need the money, they may not have the value. So that can be a challenge because if a person is trying to sell a house and they really need the money, now they will have to. They may not be able to stand on that principle. But it's true. If you can, and if the money is not a problem, then don't take away your identity. I 100% agree with you.
I had to pay 2 mortgages for 6 months, so I had to do whatever. I lived in a all white neighborhood, and so I was the only white person in about 200 homes. I'm a very nice neighborhood, but people were reluctant to come out because of that. So the realtor told me, and I hesitated for a while, just like the PK was saying. But for 6 months, paying 2 mortgages, that was painful. So I had to do that. I hope it helps somebody.
Oh yeah, I think we have a lot of people too. Sandeep, let's go.
Yeah, thank you guys very much for this opportunity. I have a quick. I have many, but for the sake of time, thank you, Kwame. Now, if you're going for pre-approval, assuming you're married, do you go as husband and wife to get the pre-approval that is with your credit as husband and wife, or do you use just go with one? And the second thing, based on the what we are just saying about appraisal and realtors, do we, and knowing that we are challenged because of who we are, minority and Black in that matter, do you advise you go with a Black person, use Black, like use your brother from your African country, or what? Would that help you? And then in your explanation of getting approval and going to get a house, the change in the amount. I know we don't have time. I think I really missed the explanation, but I think I may have the opportunity another day.
Okay. Well, so for the first question, you were asking about. I'm trying to follow. What was the first question again?
Go in as a couple.
As a couple, yes. So what I would say is that it depends, right? Honestly, when you go as a couple, if you both of you are working, then your income combined might increase the amount of money that you can get approved for. Okay. But what I have learned is you can strategically do it if you know that, okay, if this is my first home, I'm going to buy a home again in the future. And you can do it on one income, then do the home on one income. Because then when you go buy the home in the future, now the second partner can go in as a first-time home buyer. You see that? So
Yeah.
that can benefit you. So it's hard to answer this question in general. It just depends, right? But if you're going for the home and your income is not enough, you need your partner, great. If you don't need your partner, you can do it on one income, then just do that. And then when you're ready to go for the second home or whatever, now you can still leverage that first-time home buyer program out there with your partner. Or even maybe you're not going to buy a second home, but you want to get into real estate in the future. You can use your partner to buy a duplex because you only need to live in one and rent the other one. So there's so many ways you can leverage that first-time home buyer opportunity to do things. So if you can save that, then I recommend you do that. But if you need your partner's income, then that's okay too. The second question, my honest opinion, go with a good person.
And Kwame, to add to what you said, right? If you know you can do it by yourself and your partner has a horrible credit, please do not add it to it. Because now you're digging a lot of grave for yourself.
You're going to mess yourself up. Yeah, they look at you as a unit. So you can have the perfect credit, but if your partner has a bad credit, then don't do that. Yeah, that is really good. Yeah, that's really true. Don't do that. And what I recommend, if you are building your credit, and build it with your partner, because so many things that can affect you. But if your partner doesn't have a good credit, then don't even mention them. Just do it by yourself. Because the moment you bring them in, their credit can affect the whole loan. One, it can mess up your interest rate or it can even get you denied, depending on how bad it is. So yeah, thank you so much for that. That's really good. The other question, I highly recommend that you go with a good person. And I say that because even though color sometimes influences decision, you will encounter people that they are your own skin color, but they don't treat you very well. Just go with a good person, somebody that you can trust, somebody that you know is standing in your interest. And a lot of times they don't see it. That is why personally, I only work with people I can talk to face, right? One of my friends on here, he has had a white realtor who he worked with, and that was very good to him, very helpful. My mortgage person was, it's white, but they were very good, phenomenal. But I have also a loan officer that is black that helped me with my business purchases. I love him. He's great. So I don't really say that essentially go with the white or black. I say go with a good person and go with somebody that you can talk to, because a lot of people, when you talk to them, you can sense their spirit, and then you can decide whether you want to work with them or not.
Yeah.
That was my recommendation.
And to add on to what you just said right now, again, I'm going to use myself as an example. My first realtor who helped me buy my first house, she was white. And she did great. She did phenomenal the first time. I thought she did because I didn't know better, right? Then until later on, going through the process with the second one, I realized that, no, screw me up. Okay, because at this point she was the buyer agent and also the selling agent for both houses, and my loan guy was like, nah, I don't know what to tell you, but seek another opinion. And I happen to just be on the street, looking at houses. Me it's a bit open house behind my cocotra and I'm a just to watch. And I found a different realtor. She's also white, and she proved beyond somebody who cared for anybody. So me, I don't see color. I just look at the personality, and if the personality vibes with mine, like I was bombarding her with questions day and night, and she will always answer. Always. That's one thing I realized that everybody needs. If you can't find an agent who is ready to answer your questions, regardless of how irritating you can be, then you not having the right router. That person is not ready to be fit in the job. And actually, now she was even working on my terms. Hey, we have to meet this day to go do this. I'm like, I can't make it. I have work. I have this. It was like, can we do this day? Give her 2 or 3 different options, and she would choose from one. And she was always meeting me half. We were driving an hour down to go look for houses, and I felt obligated to still maintain her. And she was even just helping me not try to keep her as a realtor. So the point I'm trying to make is, if we always look at the systematic racism, we're always going to lose group people, because there's great people irrespective of race. Our own kind can screw you up, and they will laugh at you while they screw you up. So I think, like you rightfully said, find the right person when the vibe is right, when they're doing the right thing, whilst you're talking to people already know what they're doing. I bet you will find that confinement whereby you'll be able to get what you're looking for in the right direction. Yes, sir. Whether it's our own color, it's a different race, they will still mess you up. Bad people are everywhere, irrespective of, even among ourselves, our families. Not everybody, wish us well. Some wish you never made it through your life. And, so at the end of the day, if I know some of my people, right, my own family members, when you're selling a house, they'll tell you don't post in the Ghanaian community. Because nipa na be post to a Ghanaian community, in some of the kafa other people, nobody even want to come look at it. Nobody want to come look at it. And they don't even know what they're talking about half of the time. But when you post it in somewhere that people will not see now, then those people will actually come and look at it from that perspective. So it's we are own enemy more than even the other race. That's how I look at it as. Even though the systematic racism is there, you can't get rid of it. It's there no matter what you do. But at the same time, don't let that become your friend is a fog in your mind and just block you from thinking outside the box and meeting the different people from different races and stuff like that. Any more questions, please? I think the director don't mind giving us extra 5 minutes for us to.
Francis have a question.
Francis.
Did I answer all the questions you actually had there?
No, Francis made a very valid point to solidify what Collins said.
There's a question. What is your advice on buying a foreclosure as a first home?
Okay.
That's a great question for your real estate agent. Because some foreclosures are great. See, it's all about getting the right home. And I'm not able to answer that question because typically it's not a finance question and I'm not a real estate agent. Me, I like to rely on expertise. So when I'm buying, I like to get people that know what they are doing. So I would say, I don't think all foreclosures, there are some that are really, really good. Like it's because somebody, a parent died, something happened, then they ended up losing the home. And now it's on foreclosure, and then you have an insider and you buy it, and it's great. There's a book I read, and something happened. It's a true story of somebody who was trying to buy a property. Then the real estate agent told him that, listen, this house looks bad, it's foreclosed, but right at that intersection, there's a Walmart coming there, and the city has approved it, but it's not in the news yet. So buy the house. So foreclosure. He bought it. And 2 years later, the house quadrupled.
Wow.
But that came out of inside knowledge, right? And so things like that, that's why it's good to work with agents, because some agents will go that far to tell you insider information that if you have a good agent, it can change your life. It can change your life. And those little things can mean a lot. So, so I wouldn't say yes or no to a foreclosed home. What I'll say is I work with a good agent and you would find some value in your property.
That is very deep, because my agent, for instance, right, I saw this house that I was like, yo, this is my dream house. I'm going to stick with it. She went into the comms, did everything. Was like, I would highly advise not to. But if you want to, I mean, think about it. This is somebody I would talk now or not the cat regardless, right? But she was advising me not to because again, she's looking at future recommendations. And now I will highly recommend her to anybody who wants to buy a house within Indiana, Ohio, Kentucky, area, the tri-states, because she cares for your satisfaction. Francis, go ahead and please unmute yourself.
Yeah. Hi, good evening. Thanks
Good
so
evening,
much
boss.
for the opportunity to jump in here. Yeah, and thanks to Derek for recommending this meeting to me. I think it's very educative and very helpful. Yeah, so during your presentation about trying to get a house, you said the how long you've held the job matters. So my question is, in my case, being like I recently moved in here or started work. I recently moved in here and started work, but I feel like I'm making like a good amount of money that I can jump in to get in a house. I got that idea pretty much because I'm based in California right now. So I was looking for an apartment. Then one Ghanaian brother, he's been here owning a house. So I told him the amount I'm willing to pay per rent. Then he said, "Hey, Francis, man, you can really get a house. Yeah, if you are willing to pay this amount for a rent, then you can get a house, right?" So I've been thinking of it. And then during your presentation, you made a point that how long you've worked. I've not worked to 2 years yet, but I still feel like I'm making pretty much a good amount. Combined with my wife, who's also making a good amount, we can jump in, get in a house. And also we have a deal because my in-law, let me put it like that, my in-law, they are Black Americans. So she lives in a gated community for seniors. She owns a house in there. And because it's for seniors, the house rate are pretty much comparatively to other places in California is pretty much cheaper. And the down payment is just about like 3% of it. So she also told me, okay, if I'm interested, she can put herself on to be part of the resident for the house so we can buy another house in there. But I'm not so sure of it, and I'm not so sure of the process. So I'm just thinking through. Do you have any advice you could give me first with regards to my employment not qualifying or satisfying the 2-year eligibility, and then also the fact that I may want to move into that senior home with my in-law owners a resident as well, so we can get that deal. Well, if you have any advice for me, I'll be much glad. Yeah, thanks so much.
No problem. Thank you. So the first thing I'll tell you, you definitely want to work with a local lender, somebody that you can relate with. But yeah, there's a way around it. A lot of times, so you moved here, I'm assuming you moved here from Ghana, right? Francis,
Yeah,
did you move
I'm
from Ghana?
Ghanaian, but
Yeah.
I actually moved here from China, but I'm Ghanaian as well. So.
When you say you moved here, were you within the US or were you outside of the US?
I was outside of the US, but I've been here for I've been here for 2 years. But I started work not long ago. Yeah.
Before you started work, what were you doing?
I've been a student. I'm a doctor actually, so I just
that's exactly what I said. So you still qualified because being a student is still considered. They give you you still qualify because they give you that opportunity to use that to close the gap. So if you look at, I said, schooling or trade or program, and a lot of so like I've seen people like in nursing, the medical sciences, people that are just graduated, they allow you because you still have that 2-year history, and then all they will say is that you were in school. All they need is your transcripts or sometimes your degree, something. Then they will, so you don't have a problem. So you don't even have to worry about that. That will not hinder you at all. Now, with respect to
I
your
was thinking.
Go ahead.
Yeah, I was thinking that would be your history within the US. So it's good to
Yeah.
know that even outside the history of my history outside could also be used.
No,
And
as long
that's
as
good
you're
to
in
know.
school, wherever you're in school doesn't matter. The law doesn't say you have to be in school within the US, but it has to be
Okay.
a school that the lender will accept as an education in institution. So I think you'll be fine. But it's really important work with somebody you can relate with. Lenders are as important as real estate agents. Trust me. The two
Okay.
are really important. The other thing I would like to, with respect to the resident, so there's a few questions I need to clarify there. Number one, if the person already owns a place, normally gated communities are condos, meaning that there is a homeowners association, HOA. Some of you may be familiar with that. A homeowners
Yeah.
association, the concept is we take this neighborhood or subdivision or this gated community, and then all the home people that own home have come together to form an association, and then they've created rules and regulations that govern anybody that lives here. So the moment you are trying to get into that, you need to understand the rules and regulation. The reason why it's important in your case is if the rule does not allow anybody that already lives in that community to buy another house, you cannot do that option. Unless the person helping you, their name is not on any of the properties. And a lot of the gated communities sometimes have those rules. And also, if you trust the person enough, you can always put them as a resident. Putting somebody as a resident on your home or even title doesn't mean they are responsible for the loan. The loan is the person that is on the loan is the only person responsible for the home. So putting them as a resident is different. Putting them as on the title means that they are part owner. You can own the loan and then not fully own the house. I'll give you a good example. I have a couple that is married, and this incident happened a few years ago. Couple that is married, the loan is in the name of the husband, but the wife and the husband are both on the title. But actually, the wife as the primary owner. Unfortunately, the wife passes. When she passes, the husband is stuck with the debt because the mortgage is in his name, but the wife's estate has her mom, because they never did a will. Estate has her mom as the beneficiary, and that became a huge issue. The only thing they had going is they had an adopted child that allowed the husband to step in through the legal system and reclaim the home. So essentially, he was going to lose the home and still be stuck with the debt because
All
the
right.
title is different from the loan. The loan is given you by the bank. The title is the city or the state. And
Okay.
so whoever is
Kwame.
on the title is what they recognize.
All right.
So I hope that that helps you out.
Thank you very much, Kwame. And I think at this point we're gonna wrap up. Thank you guys all for your questions and your concern. I'll let Director David come over and just sign up with you. Then after that, I'll bring my final words on there. Then we will log out on Facebook and YouTube, and we'll go into the Q&A session with Tata Upset.
Kwame, again, thank you so much. I'm saying a holiday, so making the time to come talk to us really great. Very insightful stuff for both existing homeowners, first-time homeowners, those who are planning to buy the near future and actual future to get to get into the real estate space, because eventually, depending on, interest rates has not been very favorable lately, but I think the expectation for it to go down. So giving the insights to get people ready. And I don't know if it was Speaker yourself that said it, post-tax season, people might have some liquid excess cash available based on how you file taxes, of course. But again, so thank you so much for making the time for us. I know this was a two-part session, and you did the first one, there's the second part of it. So again, thank you so much, Chief. Thank you so much. And where are you located again? Where are you located?
So I'm in Saginaw, Michigan, about an
Nice.
hour and a half north of Detroit.
Nice. Sacktown.
Mhm.
Okay. Isn't that where Draymond Green from?
Yes. Oh,
Yeah.
very few people know Saginaw. So
Yeah. I know Sacktown. Okay.
yeah,
I haven't been, but I
we
heard of
got
it.
it.
So again, boss, thank you so much for making the time for us.
No
Given
problem.
that it's a holiday, we're going to take a few questions, and we'll bring the show to an end. So if you have any questions pertaining to your TapTapSend account or any ideas or things you'd like to present, We take, I think,
So,
2 to 3
Director,
questions.
before we go even go there, I'm signing out on Facebook and YouTube real quick, right? So, those of us watching us on Facebook and YouTube, please, everybody join us on Zoom whilst we do the Tap Tap Send Q&A section. If you have any question, concern, contributions, add-ons, or suggestions, just bring it on. But at this point, Facebook, YouTube, thank you guys all for coming. Thank you for listening. Thank you for watching. And we'll see you guys again next week, right here at the same time, 6 p.m. on Time with Tap Tap Send on HITV. Kwame, Nana Kwame Akowa, and also the viewers and everybody. Thank you guys all for coming and watching.